Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. We changed the format of Let's Talk Bonds in terms of the periodicity. Till this month, it was a fortnightly podcast. Now we have made it a weekly podcast, given that there's so much of dynamics happening in the bond markets, and there is an increasing need for our listeners who's been coming back to us and saying that they are clearly benefiting from this podcast, and would like to have more frequency in terms of the kinds of information that we provide in the podcast. So let's talk bonds is a podcast by INR Bonds. I'm Arjun Patsarthi, and while most of the times I'm doing the podcast, we also invite a good guests who come to our podcast and provide their views. And any of your listeners wanting to come on the podcast, please do write to us, and you're welcome to do so. Now, this week podcast, the fact is that the government bond yields are in a very flat curve. As in, when I say a flat curve, I mean that short term yields and long term yields are all at the same levels. So just to give you the where the markets are, the one the 6 months, 1 year, 5 year, 10 year, 15 year, 30 year, and even the 50 year bonds are all in a range of 7.7% to 7.15%. So this is showing that there's an extreme flatness of the yield curve as investors invest in the longer term bonds, given that there could be a short supply of bonds next year, and there is a huge demand that is arising out from the insurance companies and the provident funds, given that the economy is growing at a very fast clip, and this is causing the long term yields to shrink. And also the fact that the short term rates are still held up by RBI, who are fighting inflation, and they are likely to continue to fight inflation in this next 1 year. And rates are not looking to go down very sharply at this point of time. So, given all this, and the coming in the next fiscal year, 24-25, which is an election year, and there'll be a new budget presented. But having said that, given if we see the interim budget, the fiscal deficit in percentage as terms has come down, as also the absolute terms has actually stayed flat to last year's borrowing. And the given higher demand, and also the expected demand from foreign investors on the back of G6 being included in global in the bond indices, and also the fact that the markets do expect that long-term rates can come down as RBI fights inflation, and all put together, there is a very strong demand for the long end bonds, and the 10 to 15 and 30 year 50-year bonds are all being held up largely due to the fact that markets are expecting a short squeeze in this market in terms of demand supply gap, where the demand is much higher than the supply, which is a very unique case for India, because India has traditionally been a very large issuer of government bonds. And many a times RBI, the central bank, had to step in to actually support the government borrowing. And but now that has also stopped. So central bank, RBI's also books are also not very full, and so they're not able to prevent yields from falling. They cannot sell too much of bonds, and if yields do fall too much, they might buy more bonds, which they might. I mean, if yields fall too sharply, they don't have too much of ammunition to sell bonds, and unless they want to use some other monetary tool, which they may not do so. But that really seems to be like we have to see how the whole uh, scenario pans out. So in this scenario, what do bond investors look for? Financial advisors What do they invest? What do they tell their clients to invest in? Clearly, one sense is that if you one part of the investment portfolio which needs liquidity and no credit risk, and also a fact that there's potential for a demand supply gap, then government bonds does seem to be a good option as parts. And the second option is that given that long-term yields are at these levels and almost flat, corporate bonds giving higher yields can also be a good investment option for advisors looking to in, allocate bonds in the portfolio for their clients. In the corporate bond space, we have also seen a compression. The 10-year AAA PSUs and AAA yields have also come down around 7.5% levels. 10 to 15 year are also almost a very flat curve. While the shorter term, which is a 3-year, they are all over close to 7.8 to 8.2 to 8.5%, depending on the issuer. And this also indicates a inverted yield curve, again indicating that long-term yields can trend down, given that there's more demand at that end of that scale. But having said that, in the next 1 year, if inflation does fall and RBI looks to ease up on liquidity, and there could be either the curve inversion being more flattening out in the corporate bonds, or even a steepening a bit, which could mean that 3 to 5 year bonds can also give a good carry and a potential for an improvement in prices as well as yields fall. On the lower end of the spectrum, from the AA and below, we have seen a lot of issuers coming to the retail market to borrow. We have seen many public debt issues in the last few months, the latest being Navi Finsurf. Then you had companies like Ugro Capital coming to 360, coming to tap the market. All done reasonably good issues. And we are seeing a good retail demand for bonds as well. And so across the spectrum, there does seem to be a good amount of activity, which is likely to continue into the next year. So in all this, bond markets do tend to look very vibrant going forward, with lack of supply in government bonds that can drive down more interest in the corporate bonds, especially below the AAA basket. Thank you very much for listening in. Financial advisors, do come to our partner portal where you can see the best bonds available in the market, all the bonds available in the market, get all the information that you require, and the easiest interface to transact for your clients through a registered OBPP, which is INR bonds. OBPP is online bond platform provider. We are a SEBI registered OBPP. And the transaction is seamless and extremely efficient, all through the clearinghouse of the exchanges. Thank you very much for listening in. Do follow us on all podcast channels.